Ladies and gentlemen, welcome to today's highly informative webinar. It's focused on navigating income tax pitfalls in the realm of life insurance. And we've got the privilege of hosting an esteemed expert in this field, V. Gail Brannick, JD CPA, as the technical director of the Advanced Consulting Group at Nationwide. Gail brings over 25 years of experience in business, wealth, and tax planning to the table. Gail has an impressive track record in buy-sell strategies, non-qualified deferred compensation, executive bonus arrangements, and split dollar planning. Today, she is going to shed light on the intricate nuances of income tax implications surrounding life insurance, covering crucial topics such as premiums, death benefits, loans, withdrawals, surrenders, 1035 exchanges, and sales. So prepare to enhance your knowledge and protect your clients from potential tax traps. But before we hand it off to Gail, I just want to introduce Keith. Keith Scatino is one of our life sales VPs with over 25 years of experience, and is well suited to support you guys as you have questions. And we will also share his contact information at the end of this call. But actually, before I hand it off to Keith, just want to mention to everyone, please use the chat function or the Q&A function to answer questions as we go, and we'll answer those questions at the end of the webinar. So Keith, I'll let you say a few words.
Great. Thanks, Glenn. Hello, everyone. Thanks for spending some time with us today. I'm actually really looking forward to this conversation. It's something that on the life insurance side does come up quite a bit. Frankly, a lot of this information is stuff that you got to go back to your life insurance exam the tax provisions associated with that, of where you actually read material on it and took note, trying to remember that and gaining that knowledge. So we see this a lot in the designs of products and things that we're using, in the IUL space in particular, which Nationwide is a great partner of ours. Business planning, this is actually a tremendous resource for the business relationships that you might have out there. And it comes up more often than not. And also it's a way to potentially create some conversations just to make sure maybe there's some plans or products in place with a relationship that you have that you might not have implemented. You can use some of these tools and techniques to do a review and provide your client good guidance as to how to manage their policies going forward on a personal level and in the business space. So thanks again for attending, and Gail, I'll let you run with this, but I'm looking forward to this conversation. Thank you.
Thank you, Keith. Thank you, Glenn. Thank you all for inviting Nationwide and having me here today. I appreciate the opportunity to talk about everyone's favorite subject, life insurance and income tax. We all know that life insurance can be a really great thing. Of course, I may be a little biased. I come from Nationwide, but life insurance is an excellent vehicle, provides death protection, and it provides some income tax advantages you can't get with other products, such as the tax-free inside buildup, the ability to take withdrawals on a FIFO basis, meaning basis comes out first before you have to take any income, and then you would switch to loans, and the income tax-free death benefit. There's some really great income tax reasons for clients to use life insurance as part of their overall planning. However, we do want to make sure when we're working with clients and helping them with their overall planning that we don't unwittingly fall into a tax trap. So that's what this presentation is going to talk about. Before I get started, take a minute to read this important disclosure. Basically, we are not providing legal or tax advice. This is for educational and informational purposes only. So let's get into the agenda. So we've got this divided up This is it's in question and answer format. Now, some of you may not want to participate and put your answer into the chat box. It would be great if some of y'all did. You don't have to, but I am going to ask the question, give you a minute to think about it, and then go through the answer and why. And some of these are kind of trick questions, but we've got it divided into talking about premiums as well as death benefits and where the tax traps are there, loans against the policies and some things to understand, as well as taking distributions from the policies or even surrendering the policy, 1035 exchanges, and then finally we'll wrap it up with the sales of policies. So we've got several different areas where we want to make sure that we know what we're doing in order to avoid any unexpected income tax consequences. So our first question, we have Kelsey, and Kelsey's wonderful. She works for Nationwide, and Nationwide wants to give her a bonus to pay for a life policy that she owns. Is the life premium a deductible business expense to Nationwide? It's going to give you a minute to think about it. So this is kind of a trick question because the answer is no. The life insurance premium is not a deductible business expense to Nationwide. Now you're going to say, but it is deductible. Nationwide can deduct the amount that it pays to Kelsey because Kelsey works for Nationwide. So what Nationwide is doing is paying compensation to Kelsey in the form of an insurance premium. So it's kind of like any kind of benefit that would be deductible to Nationwide paid to Kelsey. So it's not deductible because it's an insurance premium. It's deductible because it's compensation. So this is a question as part of the advanced consulting team at Nationwide that we get very often about deducting life insurance premiums. And generally, life insurance premiums are not deductible. They're not deductible to an individual as a personal expense, and they're not deductible to a business as a business expense. Compensation is deductible, which is what this bonus is, but the life insurance premiums are not. So the general rule is that life insurance is not deductible, and then there may be exceptions to the rule, but those exceptions need to be specifically authorized in the tax code. So if you think about the specifically authorized deductions in the tax code, you think about things like mortgage interest, student loan interest, health savings account deduction, state and local tax deductions. Those are deductible because the tax code allows it. So a premium is not deductible by the individual. It's not deductible by the business. So what happens, and this is a very common area where people aren't clear, when we have a business owner and that business owner wants the business to pay a premium on a policy on his or her life, is that deductible? It's not going to be deductible unless, again, we've got compensation. It's not deductible as a life insurance premium. It could be deductible as compensation if the policy is owned by the individual and the individual does take that income inclusion on their W-2. So that is the only circumstance in which it would be deductible. So can you have a policy that a business owns and is a beneficiary of, such as a key person policy, or a policy used to fund a buy-sell, or a policy used to fund a non-qualified deferred comp agreement? Is that going to be deductible? Is that premium going to be deductible? No, it's not deductible. And if you think about it, it really makes sense that if a business owns a policy and if the business is the beneficiary of that policy, it's not, they shouldn't get a deduction because it's an asset. I mean, if it's a permanent policy, they are going to be able to record the cash value on their books. It is an asset on their books, and that death benefit is going to come to them income tax free, assuming that they don't fall into any other tax traps. So it's not really an expense, it's an asset. So that's kind of something important to help your business owner clients understand. And that's where we've got the death benefit here. That death benefit is going to be income tax free as long as we've done everything right. We haven't run afoul of any of the tax traps that I'm going to talk about. So let's look at the next question. We have Tyler, who bought a policy about 10 years ago with a $250,000 face amount. He named his sister as the beneficiary back then. So Tyler decides to sell that policy to his sister for $100,000, which is the fair market value at the time he sells the policy. So if Tyler dies shortly after that, will the death benefit that his sister received be taxable? So, or partially taxable. Yeah, the answer is yes, partially taxable. And that is because while it is not a reportable policy sale, and we're going to talk about the reportable policy sale in a minute, this is a transfer for value. And we're going to go a little more in depth on the transfer for value and the reportable policy sale in the next few slides. So Tyler's sister would have income to the extent of the death benefit she receives exceeds her investment in the policy, which would be that $100,000 plus any premium she pays before he dies. So let's look at the rules of the reportable policy sale. So we have a reportable policy sale when we have someone who acquires a life contract or an interest in a life contract, and the two parties have no substantial family, business, or financial relationship with each other than this specific transaction. So the reportable policy sale rule were adopted as part of the Tax Cuts and Jobs Act, and they're going to apply even if we don't have a transfer for value. So you've got to look at two things. You've got to look at whether we have a substantial family, business, or financial relationship, and you also have to look at whether we have a transfer for value. So let's look at the transfer for value rules. So the transfer for value rule is going to apply if we have a transfer of a life insurance contract for valuable consideration. Then we may cause some of the death benefits to be subject to income tax, and that's going to be, again, the same as reportable policy sale. It's going to be the death benefit less the investment in the contract, which would be the amount paid for the policy plus subsequent premiums. So we've got to look at the transfer for value rule, and valuable consideration is not just money. The most common way to think of a transfer for value circumstance when there's no money exchanged is when we have a C corporation and we have a buy-sell where we have business owner A and business owner B, and they already own policies on themselves, and they sell their policies to each other in order to fund the buy-sell. That is going to be a transfer for value. And even if they just swap the policies and there's no cash actually exchanged. So in this case, Tyler's sister paid $100,000 for the policy. Let's say she paid an additional $10,000 more in premium. If she collects that $250,000 death benefit, then she's going to have $110,000 that's income tax free, and then the remaining $140,000 is going to be taxable to her. Now, fortunately, we have several exceptions. Oh, okay. I had turned off my Teams, apologize for that. Fortunately, we have several exceptions to the transfer for value rule, which will help us out in certain circumstances. So the first exception is where the transferee's basis is determined by reference to the transferor's basis. So that's your usual gift circumstance. So you think about, okay, I do cases where mom and dad transfer a policy to an ILET and there's no transfer for value. That's going to be why, because that meets the exception, because the ILET is taking the basis of the person transferring the policy. And then we also have exceptions for certain types of acquirers of the policy or transferees of the policy. Transfer to the insured is always going to be an exception to transfer for value. You don't have to worry about it if it's a transfer to the insured. A partner of the insured. So this is a partner of the insured in a valid bona fide partnership, or it could be an LLC taxed as a partnership, but not a corporation, not an S corporation, not a C corporation. A partnership in which the insured is the partner. Same thing, partner, LLC taxed as a partnership, but not a corporation. Or the corporation in which the insured is an officer or shareholder. So the corporation, it can go up from the individual to the corporation. But if you've got co-shareholders, there's no exception for that. So if I am an officer in a corporation, I can transfer my policy to that corporation without a transfer for value. However, I cannot transfer my policy to my co-shareholder regardless, because it doesn't meet the transfer for value exception, because we are not partners and I'm not transferring it to the corporation. I'm transferring it to a co-shareholder. Now, just to make things interesting, even if we have a transfer that an exception applies to, the exceptions are not going to apply if we have that reportable policy sale. So again, that reportable policy sale is there is no substantial personal, business, or financial relationship between the person who is giving up the policy and the person who is acquiring the policy. So we've got to get over that hurdle first. So even if you have an exception to transfer for value, if you've got that reportable policy sale, there could be some income tax on part of that death benefit. So let's move on from that fun to the next question. We have Dan, and Dan is a key person at Nationwide. And he decides to purchase a policy on his own life, or excuse me, Nationwide decides to purchase a policy on Dan's life, and it names itself as the beneficiary. So this policy is owned by Nationwide, and Nationwide is the beneficiary. We've already established that's not going to be deductible to Nationwide. That was part of question 1. So Dan's is in the top 35% salary-wise of all the employees of Nationwide. Will that death benefit be partially taxable to Nationwide? So this is a policy that Nationwide owns and is beneficiary of on someone who is a top earner at the company. Will that death benefit be partially taxable? The answer is yes, unless Nationwide complies with the employer-owned policy rules. So the EOLI rules, or employer-owned policy rules, apply to policies that are owned by employers on their employees. The general rule is that the death proceeds less investment in the contract are going to be subject to income tax unless notice and consent requirements are satisfied before the policy is issued. And we have to meet one of these prongs here on the bottom of the slide. We need a director or highly compensated employee, or someone who was employed anytime during the 12-month period before death, or that death benefit was paid to the insured's heirs or family, or used to buy the insured's interest in the business. So in your buy-sell context. So let's say that Dan is highly compensated. He will meet the prong on the second bullet. But if Nationwide has not filled out that notice and consent, given Dan that notice and consent, before the policy is issued, then they have failed to satisfy all of the requirements of 101J for the employer-owned policy rules. So let's look at what we've talked about. So we can put these general rules together. We've learned that individual life insurance premiums are not deductible if they are paid for by the individual or if they're paid for by a business. But what is deductible? Compensation. Compensation is deductible. We've also learned that death benefits are going to be generally income tax free, but they may be partially taxable if we have a transfer for value or reportable policy sale, or if we have a violation of the employer-owned life insurance rules. So just for fun, we've thrown in a true or false question here to wrap up this section. So the death benefit from a MEC is income tax free. Is that true or false? Again, this is another trick question. It is true. The death benefit from a MEC or modified endowment contract is income tax free. Both MECs and policies that are life insurance policies under the code will have an income tax free death benefit. MEC status really only affects the taxation of certain living benefits, which we are about to get to. So nice segue there. So now we're going to talk about the tax consequences on certain living benefits, including loans, surrenders of the policy or withdrawals from the policy, 1035 exchange, and sale of the policy. So let's look at our next question. We have Stephanie. Stephanie owns a contract. It is not a MEC. Her investment is $60,000. Her cash value is $100,000. Stephanie's going to take out a $30,000 loan against the policy. How much is going to be income taxable to Stephanie? So the answer to that question is 0. Loans are not going to be taxable because this is a non-MEC policy. Now, the rules would be different if it were a MEC. If the policy were a modified endowment contract, that loan could be taxable to the extent that there is gain in the policy. So the owner could be taxed on the lesser of the loan taken or the gain in the policy. In addition, if we have a modified endowment contract, then the owner could also be subject to a 10% penalty if they are under 59.5. There are some exceptions to the 10% penalty, such as if the owner is disabled or if the distribution is part of a series of substantially equal periodic payments made over the owner's life expectancy. But the important thing to remember is you have a MEC, you take anything out of that MEC, borrow from that MEC or take a withdrawal, A, it's going to be taxable, and B, if the client or the owner is under 59.5, we could have that 10% penalty on top of the taxation to the extent of the lesser of the gain in the policy or the amount that is borrowed or taken out. So just for a refresher, what are MECs? Modified endowment contract. These are policies that run afoul of certain testing rules. In short, they don't meet the definition of life insurance. Generally, it's because the investment portion or the cash value portion is going to be too high in relation to the death benefit. So it's no longer considered a protection product. It's considered an investment product. Of course, we can run illustrations making sure that we don't have a MEC, but we do have clients who do have MECs, and sometimes we use MECs. So it's important to understand the consequences of them. So in our next question, we have Stephanie. She's got her investment in the contract of $60,000. She's got $100,000 cash value. What happens if she decides to surrender that policy? So Stephanie owns this policy. It's a non-met contract. She surrenders the policy. What are her income tax consequences going to be? Well, if she surrenders the policy, she's going to get that cash surrender value of $100,000. Her investment in the contract is $60,000. So she will have income tax, ordinary income on $40,000. $100,000 minus 60. So surrender, when we surrender a policy, whether it's a MEC or a non-MEC, the proceeds are going to be taxable as ordinary income to the extent that they exceed the investment in the contract. And of course, we've been talking about the investment in the contract. It's going to generally be total premiums, if there was any consideration paid, such as in a sale, and if there were any distributions taken out, then they would come out of that investment in the contract. So what about withdrawals? So if we have a non-MEC contract, the general rule is that withdrawals are going to be tax-free up to the investment in the contract. This is, I think I mentioned it earlier, the first in, first out, or FIFO taxation. The basis comes out first. So that's an excellent tax benefit that really makes life insurance attractive. We do have, however, some things to be aware of, some exceptions to look at. One that I get a lot of calls on is when we have a 1035 exchange, and if the client took money out too close in time before or after the 1035 exchange. Now you say, what is too close in time? We don't have a hard and fast rule on that. Generally, I say I want to see about a year. Other people feel 6 months. Other people feel next calendar year. But if the client takes a withdrawal from the policy and then does a 1035 exchange, the service may look at that transaction as one transaction, and that withdrawal caused money to be received as part of the 1035 exchange. And then that becomes boot, which becomes taxable. So we want to be careful about taking withdrawals out close to a 1035 exchange. Another circumstance where withdrawals may be taxable is that if we have certain withdrawals during the first 15 years of a policy that reduce that death benefit, they're going to receive LIFO, or last in, first out taxation, up to what we call the recapture ceiling. This is known as the recapture rule. So the recapture ceiling is an actuarially determined figure. So this only happens in some circumstances. Certainly there are cases where clients have taken withdrawals in the first 15 years of the policy and they have not had any negative income tax consequences. The thing to be aware of here is that this recapture rule does exist, and make sure that we are not running afoul of it. So I talked about loans from MECs earlier and how they are taxable. Withdrawals from MECs are the same way. They're going to generally be taxable to the extent of gain in the contract. So really that's the last in, first out, the LIFO treatment. And if the client is under 59 and a half, then that 10% penalty may also apply unless an exception is met.
Gail, just when I appreciate those slides, because modified endowment contracts kind of have a bad reputation. I literally talked to an advisor last week that was completely not wanting to talk about a MEC at all. But there are instances that modified endowment contracts are definitely a viable tool in the insurance world for clients to use. And, having a good understanding of the, taxation regarding that helps better, promote that and utilize it in the right circumstances.
We do use MECs, and one advantage to a MEC in many cases is you might be looking at a single premium contract, so it's a one and done. And you're going to use a MEC when they are pretty darn sure they're never going to take a withdrawal from the contract, but you're going to get that death benefit, and it's income tax free. So the death benefit doesn't change. So yeah.
And we compare it to it as well. Non-qualified money's going into an annuity. It's
Mhm.
taxed in the same manner, but now you add in the death benefit component and living benefits like chronic critical illness or a long-term care rider added to a policy. So we waged that conversation of how to utilize those non-qualified funds. Do I put it in another annuity, or do I look at a single premium life contract that has all these other benefits as well?
Good point. Thank you. So in our next question, we have Soheil, who has a life insurance policy that he purchased 16 years ago. That is a non-MEC. Soheil is 59 and a half, and the investment in the contract is $100,000. The cash value is $190,000. What happens if Soheil's in the 20% income tax bracket and he takes the withdrawal of $20,000? Well, this is another trick question. This is a life policy that's a non-MEC. He's got an investment in the contract of more than the amount that he's going to withdraw. He's got a $100,000 investment. So he's going to get that FIFO treatment. So he's going to get that $20,000 income tax free. It is important to note that will reduce his investment in the contract. I showed you the formula a slide or two ago. So now his investment in the contract is 80 for purposes of, when he takes his next withdrawal, he will eventually get to the gain if he keeps taking withdrawals in it, but he gets to take all of that basis out first. So let's say that he buys a MEC and he's under 59 and a half, he's 59. The investment is $100,000. The cash value is 190, same numbers here, takes a withdrawal of $20,000. He's in the 20% income tax bracket. So how much tax is Soheil going to have to pay? Well, it's in the 20% income tax bracket. 20,000 it's going to be LIFO. So the gain is going to come out first. We got $90,000 of gain. So that full $20,000 is going to be taxable. He's in a 20% bracket. That's $4,000, but there's an additional 10% penalty. So that's another $2,000. So the amount of income tax that he's going to be liable for is $6,000. So now let's move into an area that is a lot of fun, get a lot of questions on this, 1035 exchange. So under the code, certain insurance products can be exchanged for other products without having any kind of recognition of gain, as long as certain requirements are met, such as same insured before and after. You can exchange a life insurance contract for another life insurance contract, an endowment contract, an annuity, or a qualified long-term care contract. You can exchange an endowment contract for another endowment contract, an annuity, or a qualified long-term care contract. And you can exchange an annuity for another annuity or a qualified long-term care contract. So things to understand with regard to 1035 exchanges is the rule, once a MEC, always a MEC. So if the original life insurance policy is a MEC, the new contract is also going to be a MEC. The owner and the insured must be the same on both the old and new policy. So you cannot do a 1035 exchange and change the owner or the insured. There is an exception to that when we have a second to die policy and one of the insureds has passed away, then the remaining insured can exchange that policy for a single life, but that's the only exception there. So let's look at the next question. We have Carrie, and Carrie does a 1035 exchange. She has a whole life policy. Her investment in the contract is $100,000 and her cash value is $150,000. So Carrie is exchanging her whole life policy into a survivorship policy. So her individual policy to exchange into a survivorship policy on herself and her husband. What would she be taxed on in that circumstance? Well, in that circumstance, we can't do a 1035 exchange. It's really going to be a surrender and a new contract. So she would be taxed on that $50,000, her cash value less her investment in the contract. And that's because, as I said, we have to have the same insured before and after, and adding Carrie's spouse means the insured is now different. So let's say Carrie does a 1035 exchange for her whole life policy into an IUL policy. And this is an individual. She's going from individual to individual. Her investment in the contract's $100,000. Her cash value is $150,000. So that contract had a $30,000 loan against it, which is extinguished in the exchange. What will Carrie be taxed on? So in this circumstance, and this is a question that I get again rather frequently, she is going to have gain to the extent she has debt relief. She is relieved from $30,000 of debt, so she will be taxed on that $30,000. This again goes back to that boot received as part of the 1035 exchange that we were talking about with withdrawals. So again, you would be looking at, if your client wants to do this, paying off that loan as far away in time as possible before or after the exchange to avoid that boot. We also have other 1035 exchange solutions that we can look at. The client can use outside money to repay the loan or have the loan carried over to the new contract. Now, of course, if there's no gain in the policy, then you're going to have, the client's not going to have to recognize gain because there's no gain in the policy. Remember, it's the lesser of the gain in the contract or the debt relief that the client receives. So now we're going to move on to policy sales. So if a client sells a policy, then anything that the client receives in excess of his basis in the contract is going to be gain. It's going to be gain on the sale. And if the policy is sold and the seller's basis exceeds the amount that the seller gets, so going to have a loss on that contract, the client does not have a deductible loss. They have a loss, but it's non-deductible. So let's walk through how this works with an example. So we have, in this case, a policy that has $70,000 worth of cash value, $55,000 worth of basis. Client sells the policy for $75,000. So there's going to be $20,000 worth of gain to the client, 15 of which is ordinary income, 5 of which is capital gain. So how did we come to that? The difference between the cash value and the client's basis in the contract is going to be ordinary income. It's an ordinary income asset. So that $70,000 minus that $55,000 is going to be ordinary income. The seller was lucky enough to be able to sell the policy for more than the cash value of the contract. So then that $5,000 in a capital transaction could be capital gain. Another example is, let's assume the same basis, but the seller sold the contract for $5,000. They're going to have a $5,000 loss, which they are not going to be able to deduct. So question number 10, we have Brian, and Brian wants to sell his policy. It has a $55,000 cash value. A $55,000 basis, cash value of $70,000. And he sells the contract for $75,000. How much is his amount realized? Well, we just went over that on the prior slide. The amount realized is going to be the amount he receives from the sale of the contract. So that's $75,000. So even though the cash value of the contract was 70, he's realizing 75 because he was able to sell it for more than the cash value. So we've talked about a lot today. I think this is a pretty dense presentation. So what have we learned here? As far as premiums go, they're not deductible if paid by an individual. They're not deductible if paid by a business. The life insurance premiums themselves are not deductible by nature of being premiums. Death benefit is generally income tax free, but we can mess that up if we have a reportable policy sale, if we have a transfer for value without an exception, or if we have a violation of the employer-owned life insurance rules. So it's really important that we keep the tax-free nature of that death benefit, that we understand these rules so that we don't mess that up. And then we have certain situations where living benefits can be taxable, like a loan from a MEC, surrender and withdrawal from a MEC, 1035 exchange where we extinguish a loan, or where we take a withdrawal from the policy too soon before or after the exchange, or on sales of a life policy. So I appreciate all of the time that you have given me today, and I am happy to answer questions in the last few minutes that we've got.
Maureen,
Well,
what questions do we have? Oh, Keith, Keith, go ahead. If you've got
So
some.
I would
Please.
say, I mean, obviously this could be a little merry-go-round as far as understanding the tax rules and regulations, and just we have available knowledgeable individuals like Gail that we could call upon, and we do bring them in with advisors and consultation to talk through different parameters to make sure. Some of the general information was as far as stuff that you see more consistent are things that's just kind of really a refresher, and as far as the MEC rules and transfer of value rules and other things. But we will always have available contacts like Gail to be able to really get into the nitty gritty. So don't be afraid to uncover some opportunities. I definitely, on the business consulting side, I see it quite a bit, where we have an individual that has had a policy paid for on their life by the carrier or by their company, and then they're looking to, say, retire, and they want to change that policy over to themselves individually. So a lot of these topics and conversation points come into play for that scenario, which we see quite a bit. And again, MECs, modified endowment contracts, we're working with those every week. There's some planning tool or opportunity there. So thanks, appreciate it, Gail.
So yeah, and the important thing to understand is not necessarily from me talking for 45 minutes, everything that I've said, but how to kind of recognize when maybe to reach out.
There is a
guys,
couple quick.
I would just, hey,
You
Keith,
gonna
I just
answer
wanted
that?
to point, well, I just wanted to point out that your contact information is up on the screen right now. So to Keith's point, Keith will be able to direct you. Well, either Keith's going to be able to answer the questions for you that you need, or get in contact with an expert that can help with any needs you have. So, but go ahead, Keith.
No, we've had a couple questions as far as whether we're going to do, we have this recording because it is such detailed information where people can rewind and fast forward to certain topics and be able to really gather that information. So there's a couple questions out there as far as whether we're going to send this presentation is recorded and going to be made available to our advisors. So.
Yeah. Actually, Maureen, do you want to talk about that?
Sure, absolutely. Thank you. So I answered a couple people just saying that we do record this. It will be posted to dmiuniversity.com, which is the website you see on your screen. And we will be sending the webinar recording for you to be able to get in your email inbox as well.
Yeah. So, and then I guess there's a question of whether or not that PowerPoint could be shared, Gail. Is that something that we're able to share with advisors?
You could send it out or post it. It's approved to share. Yeah.
Okay, great. So I think Maureen will make that available too, correct?
Absolutely.
Okay. Any other questions? Was there anything, Maureen, that we missed in the Q&A?
We got it all.
Okay. Wow. So efficient. Well, and Gail, and I love your use of the of the questions, and the situations to cover this material, I think was really helpful. It makes it a little bit more tangible for everybody. So that was fantastic. And we really appreciate your expertise. And again, everybody, take a screenshot of Keith's contact information here. Reach out to him at 781-919-2357 to get your questions answered. And go to dmiuniversity.com for webinar recordings and content related to topics like this. And look forward to the next one. So in a couple weeks, I believe our next webinar is going to be about Social Security and is CSSCS. Maureen, is it I believe we're covering our CSSCS case study, which will be an interesting, should be an interesting topic, because we're going to show you how we can build more fortified plans for 50% less money, and also be cognizant of Social Security laws and regulations that should help your clients. So anyway, with that, I think we'll wrap it up, and look for the recording and the associated PowerPoint presentation very soon. Thanks so much for attending. Really appreciate you guys being here.
Thank you for
Gail,
having
Keith,
me.
Maureen.
Thanks.
Thank you. Take care. Have a good day.